So hello and welcome back. Now we will start looking at trend analysis in a deeper way, step by step. And first we will understand the different building blocks of trends and any price movement basically. So when we look here at a chart, we can see that although the market is moving down here and it is moving up, it is never really moving in just one straight line. It's always a back and forth. In trading, we call this waves. It has nothing to do with maybe waves concepts that you have heard about, such as Elliott waves or Wolf waves. Waves are just basically how the price moves. It's the constant up and down of price movements. And when the price moves into the direction of the trend here, so the trend is obviously here downwards, how we determine the direction of the trend, that's something that we will learn in the following videos. But when we are in a downtrend, we call the trends or the waves and the price movements that go into the direction of the trend, we call them impulsive waves because they move into the direction. So in this case, the waves that go to the downside, for example here, and that's a good lesson. So if you use the line graph and you can see that is here a continuous graph, you can just right click on it, go to the settings, parameters, and then here this is the box. You can untick it and then it will turn into just a smaller graph. We can also adjust the thickness, and now we have a small graph line. So the trend moves that go into the direction of the trend are called impulsive waves. So here and here, for example, and so on and so forth. So here we do have quite a few impulsive waves that continue always the trend direction. So let me just mark it for completion. And in between those moves, you have little periods where the price is going against the trend direction. Those are called corrective waves, as the name suggests. They go, there are little corrections where the price moves a little bit into the opposite direction. It is very important to understand that, especially once we are in a trade, we need to be patient with our trades because the trend and the price will never just plummet or spike up to our take profit order immediately, but there's always an up and down, a constant flow between the buyers and the sellers. And once we are able to read those market clues, how we read the corrective and impulsive waves can help us a lot. So for example, here we were in the downtrend and the market was selling off. It was a good downtrend, but then here at the bottom something is changing. Whereas previously the price moved down here quite effortlessly, here at the top or here at this point something is changing because suddenly the price was not able to push lower here anymore. We see that first of all this will look like a corrective wave just like it has here, but then something is changing because suddenly we are breaking above the previous highest point. So we have here our previous corrective wave, and this is the price is stalling here. You can see that here on this corrective wave, it already seems quite long. So for a corrective wave, when we compare it to the previous corrective wave, it already seems a little bit long, a little bit too long for the sellers. So if this is really a downtrend dominated by people who want to drive the price lower, then the buyers should not have so much control over the price. They should not be able to drive price as high. So this is the first important clue. And then once we see that the power and the balance is shifting, suddenly the waves to the upside are becoming longer than the waves to the downside, then this should really set your alarm bells ringing, because now it means that the powers between the buyers and the sellers are shifting. Now suddenly the buyers are able to push price quite high, whereas the sellers are not really able to push price low anymore. So this is a turning point, and we will observe them later in much detail because they are very important clues about the market structure. Once we see that the market is going from a seller-dominated market where the price waves that go down suddenly are not stronger anymore, and suddenly the waves to the upside, they become longer than the downtrend waves. This is where the market will go from a downtrend to an uptrend. We can call them transition phases, and there are many patterns that we will learn later on how to trade such a market. So you can see, as long as the impulsive waves are stronger than the corrective waves, you are in a downtrend. But suddenly when you see that the the trend waves are shifting a little bit the direction, then you can see something here is not quite right. And this is something that you will repeat and you will see over and over again. You can see already this is a little bit of a different type of market, but it's clearly shows the same. You can see the market here started rallying, started going higher quite easily and quite fast. But then what is happening here? Something is completely changing, whereas the price was moving higher here quite easily. Here it just drifted off. The buyers were not able to push price higher as easily anymore, and the market was here barely making new highs. So you already can see that the buyers are not super interested in this market. Then this is a pattern which we will learn later on. It's a very important one. It is what we would call an exhaustion spike, where the market tries to make one last push to the upside, but it fails and immediately goes down. And look at what happened previously. You can see suddenly we see quite a strong of a bearish correction wave to the downside, and this is already something that should set your alarm bells off here. A very long correction wave after this very slow uptrend here. Then we have our exhaustion push where price tries to push higher but immediately gets reversed, and then here you can see now is the time where the sellers are really taking over and the new downtrend is starting here with this long corrective or impulsive wave now to the downside. No real buying interest is here anymore in the market. This is something you will find everywhere in the market. We will be able to dissect almost any price chart using this principle. You can see a very strong move to the downside, followed by a little bit of a weaker move, but still we are moving lower. Then here another push to the downside, and then here again, you notice what? Yes, that's the exhaustion push. The price tries to make a new low, tries to push lower, but it fails. And then here we see now one normal correction wave, nothing too much, but we don't see that the price is impulsively making a new impulsive wave. But here you can see now the price is breaking higher. We are breaking into new highs. That is a concept that we will explore in the next video, where we'll cover swing points very in depth. And now the market is moving higher again. And the uptrend waves are higher. Okay, we see a strong corrective wave, but afterwards immediately the buyers return and continue the wave to the trend to the upside. One last final example maybe, and then I think it should become clear what we are doing with corrective and impulsive waves, and we will build on this foundation later on. You can see here strong uptrend, very strong impulsive waves here, and you can see how we can nicely describe such a market, even though here is a little bit of a period where the market is not continuing its direction immediately. You can see, even though this seems like a deep and very long correction phase, we are never really breaking here below this previous point, which is a very important concept that we will learn later on. And you can see once the market faces such an area where the buyers took over previously, here again the buyers step in at the previous price once again. They see that now the price is low enough for the buyers to become interested again, and then here we start this new trend wave. Almost no selling interest here whatsoever. Very good impulsive trend wave, a deep correction wave, but compared to this one, not too much. And that's also one thing that is very important. The price is very dynamic on your charts, and no one price scenario will be comparable to the next one, and you always have to set it into relation to what you have previously seen. So for example, this means here we have quite a deep or quite a long impulsive trend wave to the upside. This trend wave seems to be quite long to the downside, or this correction wave, if we would compare it to what we have seen here or here. But in this context here, it's not really too frightening, I would say, because this is quite short here compared to this long trend wave. So the price will never just shoot up in one straight line, but it's normal to see this back and forth, and you have to put it into relation. Then we see here the price is moving up very, very strongly again, but now something here is changing quite clearly. After this point, the buyers were never able to continue the wave to the upside, and now it looks quite different what we are seeing here. Now compared to this trend wave, now this one looks much deeper than what we have seen here previously. So you always have to put it into context, and I think it becomes clear here now. This next wave to the upside is even shallower. You can see that although the buyers try to push higher, they never really can outperform this previous correction wave here to the downside. This is the first warning signal, and then you can see here now the sellers are really stepping up here, and now the trend direction is completely turning to the downside. And you can see what happened. The price is falling and falling and falling afterwards. So just as a little exercise before you go to the next video, I would suggest that pull up any time frame, any chart, and look at the wave, the corrective and the impulsive waves move. Look at the relationship, how deep certain correction waves go, how long certain impulsive waves go. What does it tell you about the buyer and the seller dynamic? And of course, not always will those charts that you find look as pretty as they are here in my example, but this is one concept which we will call, or which is called market selection, where we distinguish between clean and messy charts. It is a very important concept, so that every week we can find the good markets. We stay away from the markets where we cannot make sense of charts. So don't get discouraged. We will learn this in a later video, where we will cover exactly when do we analyze a chart, when is a chart not giving us a good signal. So first of all, what is now important, that look for nice trending phases on your charts. Try to analyze them with the concepts that you have seen here in this lesson, and then I will meet you in the next one, where we'll take it one step further.